here today to talk about project finance, okay, for renewable energy projects, but it can be for anything really. So what we're talking about here, let's just try and frame the discussion before we start. I come from an engineering background, and it's okay to sort of know, it's great to know about all the technology that's available, all the renewable energy technology that's available, solar panels, turbines of the kind of wind or hydro. But what we're trying to focus on today is we're trying to build up the concept of how we get those bits of, or those assets, those renewable energy assets, into the outside world, into the built environment. And normally that comes down to two things, doesn't it? It comes down to engineering and finance, and the combination of those things. I don't think I'd be too amiss to say that engineers are not really much interested in finance. I may be completely wrong, but that's the general vibe I get. But it's good to know. It's good to know as an engineer a little bit of both. And so that's what we're going to go through today. We're going to try and build it up in stages. So what's our concept? Well, we are here today because we want to build a renewable energy generator. Now, this could be, I'm talking here about wind turbines, solar arrays, hydro, but this concept can be used for practically anything. What do we know? What do we come to the table with? Well, we know that these things are not for free. They cost money. And it could be a lot of money. It could be a lot more money than we've got. And so we'd have to find a way of getting that money to spend on these things. Let's just assume that we come from a situation where we don't have the technical knowledge to build such a system and run it. And very few people hold the skills to do everything in a project. So, let's assume that to begin with. We want to make money on any project that we embark upon. And even if we don't make a lot of money, we certainly don't want to lose money. And knowing all this, we've come to this decision and we thought we still want to build a renewable energy generator for whatever reason. That may be environmental reasons, it may be financial reasons. But anyway, it's usually a combination of both. But that's what we've decided to do. How do we go about doing that? Well, in short, we use project finance. All right, that's basically what we do. And if you go online and you look up a definition of project finance, and this one's from Investopedia, you'll see the something of the definition of it's a long-term funding of long-term infrastructure of industrial projects and public services using non-recourse or limited recourse financial structure. And we'll talk about that in a bit. Debt and equity are used to finance the project, and they're paid back from cash flow generated from the project. Right? Great, that's all wonderful. Well, we can't just stop there, can we? We have to figure out what this really means and how to implement it into our business practices and our engineering practices. So I've said there, it's a perfectly adequate explanation of project finance, but I'm sure it leaves the door open to further questions and clarification. And I didn't write, and I wrote a course basically on how to do all this, and this is what we presented today. So let's start by posing another question. How do we go about building a renewable energy project like wind or solar? Let's focus on wind and solar. So we need an idea, we need a concept. So someone or a group, some people have to want to build this and operate this asset, excuse me. And not only do we have to have the want and will to do this, these things are large items. They take up land. They're physical assets that take up land, and not only do they just take up land, they take up land for a long period of time. So it's not a trivial thing. They don't make land anymore. So we need a willing landowner. We need not just a willing landowner, but we need a council and a community that's going to allow people or the company to want to build on this land. And not just that, we need a physical connection to some kind of off-taker, which is usually the national grid or a private wire. To do all this, we need technical expertise. We need designers, we need finance people, we need operators. We need a whole bunch of people to be able to do this on a technical level. And then crucially, we need money, don't we? We need money to pay all these experts, and we need money to actually keep this thing running, and we need money to buy the thing in the beginning. So we need some kind of financing. So renewable energy projects involve building real infrastructure and they cost money. And there's many ways in which these things can be done. So let's just say we live in Wales, South Wales. This is a map of South Wales. This is the land available to us, our canvas. Let's say that we want to build a wind turbine or a wind farm or solar farm, somewhere between Ammanford, Pontardawe, Pontarddulais, in the middle there somewhere. And we have a discussion. We are the people who want to do this, and we want to build a wind turbine right there in the middle of that map. And I think there's some wind turbines actually there already. That's probably why I picked this. And you approach the landowner if you can find out who they are. And he says, yeah, sure, you can build on my land. It's obviously going to cost you grand rent every year. And you've got to take them down after a certain number of years. Well, he probably won't say that, but that's sort of built into the concept of the whole thing, about 30 years. Let's make sure my neighbours don't complain, and you're probably going to need planning permission to do it. And so we ask ourselves, can we do this? And I've put we there. I've put we in a bold for a good reason, because we need to actually discuss who we are. So we want to build a wind turbine. The farmer said it's okay, which the farmer, large bits of land are normally owned by farmers. Things are getting real. We need to find out if this idea actually works on a technical level. And not just that, will it be financially viable? Will the local planning authority allow it? So who are we? We are normally what's called a special purpose vehicle. I know a special purpose vehicle is basically a limited company which an organization, a group of people would come together and create as the first step to doing anything in a project. Now, this could already have been created. You could already have a company, but if you haven't, this is what you do to start usually. So the special purpose vehicles, it's a generic name for a legal entity, basically. Or I looked up last night, the legal personality, which I found interesting turn of phrase. So special purpose vehicles are set up. They can be limited companies. They can be limited liability partnerships, public limited companies, or registered societies, which we'll have a look at on the next slide. So in the context of a renewable energy project, what do they do? Well, they own and distribute the shares, in this company. There will be a board of directors, and ultimately they'll probably be the people to make decisions. They'll have assets which they will purchase and they'll hold within that company. Loans will be taken out in the name of that company. Any income and revenue will come in and belong to that company and be redistributed. Basically, all the business will go through that company. You'll have accountants, you'll have bank accounts. Then what we saw earlier was the thing called non-recourse. So special purpose vehicles, the reason why we do them is because they're ring-fenced. All the assets are ring-fenced and have limited recourse, which means if anything goes wrong with the company, the directors are not personally viable. It's all part of the company to sort out, and they'll become liable. So anyway, we won't go on too much about that because it's not a huge part of the course. We're not really talking about that much during the actual course. A little bit on registered societies. So you can think of a limited company probably as something that is sort of a normal thing. Some people may not have heard of registered societies. They may have, especially for the people in the community energy sector. These are more aimed at promoting sustainable development. They have sort of a shared ownership and are really aimed at sort of community welfare, other than just sort of profit making, all right? And there's two sort of subsets of these. You can have cooperatives and community benefit societies, okay? So the question then remains, we know who we are now. We're part of a company or organization, and we need to ask ourselves a few more questions, don't we? So technical feasibility. How do we examine the technical feasibility? Can we construct this project within a proposed schedule and budget? Well, actually, what is our schedule and budget? And once we complete it, will this asset actually operate at its capacity, or will it break down all the time? And for that matter, what is our actual planned capacity? So as we start asking more questions and start thinking about it a bit more, we think to ourselves, well, we're going to have to do some sort of exercise here, aren't we? We have to do some sort of, I've called it resource scoping exercise. So for instance, we're going to have to figure out how much land we've got, what type of wind turbine or solar array do we need, how much energy is that going to produce every year, and obviously that's going to depend on its size and its capacity, and its size and capacity will be subject to the constraints of the local planning authority. Okay, and size and capacity will determine can we actually get this asset on the land that we want to get it on. So there's a lot of variables here that we have to try and figure out. Not only will the local council be, stipulating things like access and rated capacity and size and location, you've got to do a lot more studies. You may have to find out if there's any ancient monuments there, if there's any protected habitat, and all that kind of stuff that goes with planning, which we're not going to talk about in this course. Then the crucial one, especially in Wales, well, I say especially in Wales, I don't know about the rest of the UK, but I know in Wales this is an issue. Can we actually get our wind turbine or solar farm or wind farm, can we actually get it connected to the power grid? And can we do it at a reasonable cost? The answer probably that is no. Or is there somebody nearby, an off-taker, a large industrial estate where I can actually connect my asset to? I'll call it assets from now on, okay? I can connect my asset to them and sell electricity directly to them. And crucially, how much is all of this going to cost that we're talking about? Okay, this is called development. Who develops the idea? Well, the initial idea has to come from the company. There's professional companies who will do this every day. It's their job to do these kind of things. But as small organizations, you have to come up with an idea. We need technical feasibility, okay? So we need to do resource scoping. To do resource scoping, you can get consultants to do this for you, and they'll charge you money to do that. And obviously you have to get that money from somewhere. They'll do it with costly software. There's also things you can do for free. There's free tools that you can use online to find out sort of yield from solar and wind and stuff like that. And I've put that in bold there because we will be doing that on this course. We will be using free tools online to actually figure out what our yield is from wind and solar in specific locations, which is really, really handy. You will need planning permission. Again, that costs more money, and it costs more than what I thought, to put it that way, when you do these projects. Right? Usually you'd employ a third-party company to do these things, like Dulles. We won't cover any more in this course about planning. I'll just say that you would normally employ a consultant, and you normally have to pay a lot of money to do so. And the next thing you need is a financial model, and this costs money to develop. There are companies who will do this, and I've put that in bold again because that is what we are going to do in this course. Is we're going to learn how to do very early, simple financial modeling. So in order to have a financial model, you have to build a business model first. So now let's just assume that we've gone through a development phase and we've got planning permission and we know this project's going to work on a technical level. What's our business model? It's quite simple, really. We wish to generate electricity from our asset. We then use the revenue from selling that electricity to maintain the asset, and we also pay tax on it depending on the type of organization that you're dealing with, depending on the organization that you are, rather. And then we're going to pay back loans and pay back interest. And finally, if there's any money left over, we'll pay back that money to community funds or private lenders, otherwise known as equity investors. This isn't the only model, but we need to start somewhere, don't we? We need to we need to start somewhere, and a basic model is a good place to start. If you are a community benefit society, your model may look slightly different. The profits that you actually get may be used then to fund community projects such as energy efficient programs, fund local facilities. Interest payments may be made to members who have invested in the project. Examples of these organisations are in South Wales, in Swansea, we've got Gower Power. In Pembrokeshire, there's a company called CARE, Comarian Renewable Energy, and in Carmarthenshire, there's a company called Uniteg, and these are community benefit societies. So then, right. You see an opportunity, you want to build a renewable energy asset. Now, let's have a look where we are. We haven't got any cash. We're not flush with cash. Maybe we've got none. You've certainly never generated any cash before. and this is the case for many organisations, especially community organisations, you've got no credit history, you haven't really got any employees, you may have got a few, you may have got a few goodwill gestures coming in as well, or you may be a massive company and you've got loads of employees. You've never operated an asset before. These are really the worst case scenarios I'm putting down here. There's no guarantee if you borrow any money that you'll actually be able to repay the loan. So how do we pay for, put an example there, £5 million solar project under all of these hostile conditions? It doesn't look like a good start, does it? To be fair. However, project financing or project finance, and we read the definition on the first slide or first or second slide, relies on long-term infrastructure, primarily relies on the financing of long-term infrastructure, which relies on you having cash flow in the project to enable you to repay any loans. And it's a perfectly common way of financing large infrastructure, airports, roads, power plants, most things are built like this. So if we take the concepts we've just seen and we try and put them on a diagram, it may look something like this. And I like this diagram. In the middle here, we are our special purpose vehicle. This is where our decisions are made. This is our shareholders. This is our business structure. This is our directors. They are there. They've made the decision we want to build, I'm going to say, a wind farm in this instance. They figured out how much it's going to cost. Okay, they've got all that together. They figured out, and we're going to do this. This is project financing at the heart, really. They figured out how much all this is going to cost, and that's called our capital expenditure, and that's called shortened to CapEx. In order to pay for our capital expenditure, CapEx, they've had to approach the bank, and they've had to raise some debt. So they've got some money in. So the positive arrow, the way this arrow is going, denotes that there's money coming from the bank into the special purpose vehicle. And this money is going to be, it's going to be borrowed from the bank to pay for our capital expenditure, to pay for our asset, to pay for our wind farm or solar farm. The special purpose vehicle has also gone out into the community and they've raised equity. Okay, so there's money coming from equity as well. Now, after we've built the asset then starts to generate revenue. All right, we get income, we get a yield, we get money per kilowatt hour, megawatt hour from the our electricity sales via a PPA, power purchase agreement. So money starts flowing in. So initially money was flowing out, now we start to get money flowing in. From the money that flows in, we have to pay our operating expenses to keep this asset actually afloat and running to its peak condition. Money will then be used to repay any loans, so that's principal and interest. And if there's any money left over after doing all that, and it's not a guarantee, excuse me, we then pay back the equity. We then pay back, dividends basically to our equity shareholders. Okay, so what's a PPA? Let's focus on income from a PPA for the moment, per power purchase agreement. Basically, there are energy companies who will buy electricity from you. Just like they will sell electricity to you, they have to buy it first before they can sell it. Okay, and that's done under what's called a power purchase agreement. And there are certain companies who will buy clean energy, as they call it, or whatever they're calling it, from renewable energy assets. Simple as that, really. Talk about debt. Well, we all know what debt is if you have a mortgage or a loan. Most people have these days. Debt, you borrow from the bank. There needs to be clear. There needs to be clear visibility. If you're borrowing money from the bank, they need to understand your project. You all need to be very clear on how you will pay the money back. If you don't pay the money back, then the bank may retain ownership of the asset, and there's always risk involved. They will need to do due diligence risk assessments. They will charge you fees, and they will want security on their money, and they will do all this under the sort of, and they will also want financial covenants, which we may touch upon later. If you take a loan from the bank, there will be a loan length. You will have interest. You will have to pay back interest, and there will be fees for the privilege of borrowing money. Equity is slightly different. Equity is when you take capital from an outside investor in exchange for some kind of ownership of your business. Again, it's based on having a solid plan. You know, you want to make sure people that want to invest money in this business, they want to make sure they get a return. Typically, then investors will receive dividends every year, but that's not obliged by law. So you have to want to make sure that your business is successful. You do have to give up some of your ownership, some of the ownership in the company when you have when you go down this road again, equity, and you may be an extensive evaluation process. But anyway, in order to actually raise money from the bank, there's usually a condition where you need to get about 30% of your financing from equity. So in assessing the project viability, lenders will want to know the technical feasibility, the financial feasibility, the credit worthiness of the project to be able to service this debt, and so on and so forth. So the question really is, how do we do this financial feasibility? Or more importantly, okay, let's go back a little bit. So the technical feasibility of the project is there to ascertain the project can be constructed within a proposed schedule and budget. It's, then we have to figure out how do we operate the plant capacity, and so on and so forth, okay? The question is, how do we do this? Well, we have to understand that lenders in their feasibility proposals, in their feasibility stage, are basically trying to mitigate risks. Your project is always a risk. And a good way to mitigate risks in a project is to first of all understand them, and then secondly to allocate them to the best people placed to handle them. So we need to attract money in from the bank and investors, and we'll do so in the form of loans and equity. They need some kind of guarantee that you are serious and capable of doing this project, okay? And so they will de-risk these things and add certainty to the project and make sure there's cash flow through the lifespan of the project by allocating contracts to people who know what they're doing. And let me explain that, okay? Back to this diagram. Who is actually going to build your wind farm? Who is going to build your solar farm? Well, you employ an EPC contractor. Okay, an engineering procurement contractor, and they should be reliable and have a good track record of being able to deliver on projects. You may have an owner's engineer actually then acting on your behalf, taking, as an intermediary between you and the EPC contractor, and you want a good relationship with all of these people who you're working with. So EPC contractors could take care of the whole project for you in terms of construction. You may decide that you want other works done by local companies. For instance, your EPC contractor could be based in Bristol or London or whatever, and you're down in Swansea or Pembrokeshire or somewhere in Wales, and you want your groundworks to be done by a local contractor. Okay, so you'll have to negotiate these things with the parties involved in that box there. The revenue part of your contract is basically your power purchase agreement. So you need to have a good solid power purchase agreement with a reputable company in order for the bank to take you seriously. Okay. You then need an operating and maintenance contract as well. And that could actually be through your EPC contractor as well. But you need an operation and maintenance contract. So again, the bank and the equity investors know that it's all in hand. You're not doing this by yourself, trying to guess your way through things. You've actually gone out and you've got a solid contract with someone who knows what they're doing. And that's not the only types of contracts. In order for the bank and equity investors to take you seriously, you have to tell them, you have to make sure you've got your planning permission. You've done all your surveys, you've done all that stuff. You need a land lease with your landowner. You need to make sure you've got your rights of way sorted, the heads of term contractor. When it comes to actually selling the electricity, you need to make sure you've got a contract with your grid connection. So you need a grid connection offer or a private wire, which is a direct link between you and an off-taker, somebody who's buying your electricity. Okay, we've talked about EPC contractors and we've talked about owners, engineers. What else do we need? Financing. So let's go into that box. Typically 20 to 30%. Equities, we call them sponsors as well, or community ownership. And then obviously the bank will want to know about that relationship you've got with those funders. And so I think that sort of labours the point there that you have to have contractors. You put contracts in place to mitigate risk, basically. That's what you do. Now, earlier I didn't actually say it, but what was written on the side of the screen was timing is important, because a project takes a long time. Okay, it can take 25, 30 years, maybe longer. And in that time period, there will be certain chunks of time which will be sort of delineated to do with the pertinent thing at that time. So really what we've been talking about so far is development and construction. Now, development can take 1 year, it can take 5 years, depending on the project. But during the development and construction phase, you are basically outlaying money. Okay, you're in the minus. You're in the you put your red. You're actually spending money. Only when that construction phase is over can you actually start making money, right? Can you actually start operating? So when the operation starts and you sell electricity, that's when you actually make the money. So then that begs the question of, okay, it begs a lot of questions, but let's have a look at this. So this is our project timeline. So up the top, it's got our time along the top here. And these are our project steps. And this is a simplified version. We're not limited to these project steps. And this is our finance underneath. So who pays for what at each stage? So usually in the beginning, during our development phase, which is, I've said here, is a very high risk time, which we'll see. That's usually paid for by equity funding. And let's assume it's paid for by equity funding for now. And what will that entail? Well, you've basically got to make sure that you've got to convince the people that want to invest in your project that it's worthwhile, and you have to have all of these things in place. You have to do resource assessments, technical level. You have to do early financial planning, which is what we are looking at. You need planning and consent. You need to secure a grid connection offer. You need to arrange your PPA. You need to identify your contractors and have a good relationship with your contractors. And you need to do due diligence. You need to do detailed financial modeling and legal stuff as well. A lot of legal stuff involved until you get to financial close. Now, when you get to financial close, that's when the bank decides, okay, you've done all your due diligence, you've got all your contracts in place, so now we are able and willing to lend you the money that you want to actually start constructing this thing. All right. So this is when construction starts, and it could be months to years, depending on the project. That's when you start to draw money down from the bank. And and that's that. And then you use that loan, obviously, to actually, construct your project. And then afterwards, after that, you'll go through the operation phase, which could be 25, 30 years. And you can see the risk starts getting less and less as we go along. So this was the high risk portion. Doing the construction, it's medium risk. Things can go wrong, but then they normally can be sorted because you've done your due diligence beforehand. And then you start operating your asset. And this is when you start paying your dividends out, and then you start paying your taxes, you start paying your operations, and then you start paying your interest and principal payments to the bank. Now, if you are a community benefit society, because the idea is that you are doing things for the benefit of society, you may be able to actually draw down grants that will help you to sort of arrange these things. So that's one thing, a sort of benefit of being part of a community benefit society, is you may be eligible for grants from things like Community Energy Wales and stuff like that to be able to do these feasibility studies. Right. So the question is then really is what makes this project worth anyone's time and effort to actually do this? Why on earth would a community benefit society or sponsors, equity funders, or the bank even want to actually give this project any time? And crucially, how do we know? What is it? What are we really trying to say here? What we're trying to say is, how do we know that this project actually works? Okay. And that is going to be the subject of this course. We're going to find out. We've assumed here on the screen that this project's just going to work. But how do we know? All right. How do we know? So first of all, we've identified the key players, which are the special purpose vehicle, the company, equity investors and debt financiers and contractors. Does the project work technically? Everybody's interested in this, and let's assume it does. Does it work financially? And this is where we start doing our financial modeling. And doing our financial modeling, we're going to start to answer a few questions. We are going to figure out what's called the EBITDA, which is the earnings before interest, taxes, depreciation, and amortization. And we'll become very familiar with that in the course. We will be able to find out the project's internal rate of return, which is the project IRR. We'll be able to determine the net present value of the project. And you're going to need that. You're going to need all these numbers to convince yourself, the bank, and your sponsors that this project actually works. What the bank wants to know is, can you repay the loan? And in order to do that, they're going to want to know what's called the CFADs, which is your cash flow available for debt service. They're going to know your debt service cover ratio as well. And when it comes to equity, basically, if there's any money left over in the project, that then gets paid out as equity or to the community benefit fund, and that's what's known as equity IRR. So these things here are the basic things that you are really going to need to figure out in order to attract your investors, and that's basically what project finance is. So in the beginning, okay, you can do this. The special purpose vehicle can figure out their project IRR. They can figure out their pre-tax cash flow. They can figure out their EBITDA, their net present value. So we do that first to figure out how the project works. Then the bank wants to know its CFADs and its debt service cover ratio. And then investors want to know the equity IRR. All right. There's other things as well, like there's other things that we will do within the course of the project. We'll have a look at we'll briefly touch on taxes. We'll briefly look at depreciation and things like that within the course itself. We're not going to do that today. I'm just giving you a flavour of what's in the course, and so on. But the point I'm trying to sort of labour here really now is, how do we find out these metrics? These are numbers on a spreadsheet, basically. That's all they are. They're numbers on a spreadsheet. And that we're going to build a spreadsheet. And the spreadsheet's going to look a little something like this. Well, it will look pretty much exactly like this. Now, I'll go back a few slides and I'll have a look at it in sort of a cartoon form. So your spreadsheet will contain certain things. It will contain a timeline, which is usually in years. It could be in months or quarters or all on the spreadsheet. And let's have a look at this in a little bit more detail. Well, in the beginning, in year 0, in period 1 or year 0, and I do get confused with those doing the course, as you'll see. I'll call it year 0, I'll call it period 1, I'm all over the place with calling it that. This is our CapEx. This is when we actually start, this is where we spend our millions, right? We spend our money. So in year 0, we spend our money. We don't have any revenue in year 0, but we do have revenue in year 1 to, I've called this 19, all right? It doesn't matter what it is. We don't have any operating expenses in year 0, but we do have operating expenses in year 1 to 19. And the idea of the company is you try and make estimates of these things, right? So the company would go out and they'd talk to the EPC contractor, and the EPC contractor would say, right, it's going to cost me £5 million to build this solar farm. Brilliant. That's our CapEx, right? Then we go down to the next stage, which is trying to figure out our EBITDA, which is our revenue minus our OPEX. By the way, I just want to say, don't think that you're going to get... I'm not trying to explain to you how to do this here. I'm trying to explain to you what's in the course, okay? Don't go away thinking, oh, I need to know what the EBITDA is. Okay, it's revenue minus OPEX. So you can find that out online. We're not here today to do that. I'm here today to explain to you what's in the course and what you will find out. We will, from that, we'll be able to figure out our project IRR and our pre-tax and pre-finance, pre-tax and pre-finance IRR. We'll then look at tax and depreciation. We'll look at depreciation allowances. We're not going to dwell on that because I don't like to get into the subject of tax too much on this course, but it is important that we recognise it. We can look at our project IRR. Then we look at our debt, interest, and principal. Then we look at our, after we look at the things above that, then we start to bring in our financing, which is our debt. At this stage, we can figure out our CFADs and our debt service cover ratio. And then if there's any money left after that, we look at equity IRR. And that's basically what's called the cash flow waterfall. We take our revenue, we take our expenses, we adjust for net working capital, we get our EBITDA, we then pay tax. After that we pay back the bank, and after that we pay back equity. All right. And this is the kind of spreadsheet that you'll be looking at. And during the course, we are going to be building this spreadsheet up bit by bit. I'm not just going to give you a spreadsheet and explain it. I'm not going to say, oh, well, this is the timeline, and this is the periods and all that. We're going to be building this up step by step by step. All right. We'll have a look at every aspect of this spreadsheet in little modules. And trust me, by the end of it, you will understand how to generate this spreadsheet, and it'll be no problem. You'll be able to do it. Okay. You will need some spreadsheet experience. I will say that. You will need to understand how to use Excel. I'd say at a basic level, okay, before we embark on the course. So just be prepared for that. So, this is just like a sheet of numbers, which for most people is so daunting, and for me it's daunting as well to see all these things. But because I wrote it, I understand it, and you will as well. There's no point looking at these spreadsheets and trying to understand them. You have to sort of interact with them and build them. Or maybe you don't. Maybe you're just happy once you've actually understood what these terms mean. You can go, oh, okay, well the project IRR is 4.9%. Our net present value is in the positive, so that's good. We've got a minimum debt service cover ratio of 1.06. Is that good? Should we talk to the bank about that? And our equity IRR is 2.38. I'm looking at this project now going, this is not a very good project. The bank wouldn't accept this because they're usually looking at a minimum debt service cover ratio of about 1.2. All right. And what you'll learn is how to actually tweak those things. Okay, so do I need to bring down my cost? Do I need to find a new PPA to bring up my revenue and all these things? And I'll give you an example of how cash flow works because we've got a bit of time. Let's just say we're going to build a solar farm. It's going to cost us £1 million. Every year we're going to have a revenue of £77,000, and it's going to cost us £16,300 per annum. I don't know why I chose these numbers to run this thing. What have we done here? Well, we've just made a statement of cash flow. Cash flows into the company from revenue, and cash flows out of the company as a result of keeping business going. In year 0, or the first period, we've built it, and it's cost us £1 million. Therefore, cash flows out as a negative. Once we start to operate and generate an income, we generate an income of £77,000 a year from cash sales from a PPA, and we spend £16,300 from doing so. We did this for 10 years in this particular case. Is it good? Does it work? Is it a good idea? And that's where you start, and that's where you start to use these spreadsheets to actually figure out if that's a good idea or not. That's a very basic illustration there of a cash flow statement, okay? And we'll be looking at more of those. We'll also be looking at some free software, which is Open Solar, Easy PV, PVGIS, which I'm not sure whether it's free anymore. I looked at it the other day. It's a European Union funded project which enables you to work out your yield from solar. And we'll have a look at Renewables Ninja. I'm about to put out a series of videos looking at each one of these, and they'll be freely available online on YouTube or on our website or something like that. And so you'll be able to see individual sort of small modules out there. And maybe have a look at those and see if they're useful for you and come and do the course. Of course, you could pay a consultant to do all of this for you. Okay, but by the end of this course, these are the things that you should know. First of all, you'll be able to build a spreadsheet yourself. You'll be able to understand what EBITDA means. Some of you may know what EBITDA means already. You'll be able to understand things like EBITDA and these sort of weird financial terms. You'll be able to sort of get a feel for the construction expenses of real life projects, the contractual obligations as well surrounding those. You'll get a feel for what the operating expenses are. You'll be able to calculate using free software. your yield, okay, your megawatt hours per year for your asset. You'll be able to understand discounted cash flow analysis, which is the value of money over time, which is basically the whole point of doing these timelines, is because you'll be able to work out over time how much your money is worth. And that then really ties into what is net present value. And we'll talk about what net present value means. We'll talk about what the project IRR really means. We'll have a look at things like depreciation and capitalization. We'll have a look at different debt schedules. Debt isn't just debt. You don't just pay back the bank. There's different ways of paying back the bank. Fixed principal payments, annuity payments. We'll talk about equity in more detail. We'll talk about cash flow available for the debt service, which is basically how much money do you have left after you've done things, pay tax basically, to service your bank loan. We'll talk about equity IRR. We'll have a look at Excel techniques and shortcuts. We'll look at spreadsheet formatting, and we'll have a look at much, much more. Basically, at the end of this course, you should be able to talk the talk a little bit. Okay, you should be able to go into a meeting, and when someone says, "What's your EBITDA? What's the project IRR on this?" At least you'll have, a fairly decent grasp, on the terms that are used when you go into meetings and someone asks you these questions, or the bank wants to know these questions, the answers to these questions. You won't be as daunted like I was, when I first started going into meetings and they were asking me these questions and I couldn't answer them. Well, I could answer them, but I didn't know what I was talking about. Crucially as well, especially in Wales, and obviously our projects run in Wales, and especially for the community energy sector, but it's it doesn't matter so much. We'll also be comparing the model which you make, which I've shown you, against a well-established financial model which is freely available from the Welsh Government. This is the Welsh Government Energy Service model. And most people you talk to in the sector, they may know a little bit about this model, or they may be completely put off by it because it's big, it's useful, it's unless you know the basics of what I'm showing you in this course, using this model can be very, very difficult. It can. But we will go through it. We will actually go through the Welsh Government Energy Service model. We'll take the model that we create and we'll compare that against the inputs for the Welsh Government Energy Service model. And we'll see that actually it's very useful and it's not so daunting. I think that's a very useful part of this course. And I've spoken to people in other places as well who have got similar models and have the same kind of problems. So if nothing else, if you're using the Welsh Government Energy Service model, come and do this course and it'll be a lot better. So the assessment then, this is a course and it does include an assessment. But what I don't like assessments in general unless they're useful. And so I've tried to make this assessment useful. And I've said there's going to be an example. And the example is I'm going to give you a 5 megawatt solar farm as a project. There's the location on the screen there, but it doesn't really matter. What are the inputs to the model? Well, we know that it's going to be 5,000 watt. We know it's going to be south facing. We know we're going to have plant availability of 95%. And we'll go through each one of those things in the course, all right? I'm going to ask you to calculate the yield using PVGIS or Renewables Ninja. It doesn't matter. You can use other methods. I'm going to tell you that it's going to cost £5 million. I'm going to tell you that it's going to cost you £11,000 to get your grid connection, to get your asset on the grid. I'm going to tell you that it's going to cost you £15,000 a year to actually operate this thing, and you're going to have a PPA agreement of 11 pence per kilowatt hour with a company. Okay, it's going to take you 1 year to construct this project, and it's going to operate for 25 years. Now then, this is reality. You tell me if this project is going to work, and that's what this course is. You will figure out. That's a good illustration of, right, here's the question. This is a perfectly fine question to pose to anybody who wants to build a renewable energy asset. Is it going to work? Okay. questions you're going to need to ask yourself. How's it going to be funded? Well, usually about 70-30% the debt to equity ratio. We're going to go to maybe the Development Bank of Wales or some other bank, and they're going to give us an interest rate of 6%. You're going to use a discount rate of 6%. You don't know what that means yet, or maybe you do know what it means, but you will find out that in the course, and you're not going to pay any tax on this. You will decide what depreciation schedule you use. You will decide what debt schedule you use. You'll figure out what depreciation schedule and debt schedule is within the course. After that, you're going to tell me, well, a part of the examination actually is you to tell me, does it make a difference what schedule you use? And the answer is going to be yes. I then want you to tell me what the project IRR is and the net present value. I want you to tell me what my minimum debt service cover ratio is and maybe the average, and what my equity IRR is. Okay. From this, you're going to be able to apply certain rules, which you will learn during the course of the project. You'll be able to tell me that if my internal rate of return is more than my hurdle rate, then we can proceed. If my debt service cover ratio is beyond 1.2, then we can proceed. And if not, then we can't, and we need to figure out why. Now, all of that stuff may at this point be complete and utter jargon, but the point is I'm trying to labour again is those are the kind of things that you're gonna come to, and those are the kind of things that this course is going to teach you. Now, it's very important that I personally, as part of this project, okay, tell you that obviously this is an introductory course. It has limitations. We cannot explore the whole world of project finance in this course. I haven't got the skill to teach that, or the time, or the ability, okay? Maybe one day I might. Things we do not cover in this course. We do not look at tax in general, okay? We don't look at tax loss account. We don't look at it. We don't look at interest during construction, but you could. That's not something that's beyond the you if you actually can add it on to this course. When it comes to wind and solar yield, we're only going to scratch the surface because we're going to look at free software. We're not going to look at things like P90 and P50 figures. I'd like to in the future. We're not going to have a look at inflation, payback periods, levelized cost of energy, dividends payments. We're not going to look at decommissioning costs. We're not going to talk about debt service reserve accounts and maintenance accounts, fees, development costs, and many, many, many more things we're not going to look at. However, once you've understood how to use the model, it's not a giant leap for you to actually figure these things out yourself and start to integrate them into the model itself.